Finovate showcases cutting-edge banking and financial technology through a global conference series featuring short-form demos and thought leadership. Now, the conversation continues on the Finovate podcast.
Hi, everybody, and welcome to the Finovate podcast. We've got a fun one for you today. I'm chatting with Rodney Williams, co-founder of SoLo Funds. Rodney, thanks so much for taking the time.
Thank you for having me. It's a pleasure.
So as we like to do on this show, I'd like you to start with just a quick kind of 60-second intro of yourself and your background and how SoLo Funds came to be.
Definitely. Well, hello, everyone. I'm Rodney Williams, co-founder and president at SoLo Funds. Prior to us really deciding to create a product for everyday Americans, I started a company called Listener, largest investor being Visa. And prior to that, I was at Procter & Gamble. I would say I have been historically obsessed with problem solving, and that's kind of what gotten me to this point. As it relates to SoLo Funds, is actually it stems from a personal story of our friends and family needing access to short-term capital, and also our friends and family not having a way to grow the capital they do have. So for us, we decided to create something more human, something where people can support each other and people can step up for each other. So borrowers can make a request, name their own price, decide how much they need, when they're going to pay it back, and another person can then lend them that capital and make a return. It could have happened faster, but in a relatively short period of time, we've crossed over 1 million loans funded. We've distributed nearly $300 million back into underserved communities. Our lenders have made well over $20 million in net income. And we have surpassed the transaction volume of $500 million. And that's all a testament to the community and the growth that they have decided to do, because we've never been the ability to afford the great marketing campaign just yet. But I think it is a true testament to just building a product that Americans want and need. But pleasure to be here.
Yeah, no, I mean, I think the stats are very impressive, and don't be too hard on yourself for taking a full 5 years to get where you are. That's really, really strong results. And I think, I want to talk specifically about SoLo and kind of come back to the way that you structured things, because it's fascinating. But I want to start with some broader context, because it's no secret, people who've been in the fintech space, the finance space, we've known for a while that there are communities that are chronically underserved. There are people who struggle to build wealth, who struggle to get out of this kind of trap of generational inability to build wealth. And as a society more broadly, we've really struggled with this. As an industry specifically, fintech has struggled to really make a significant dent in that problem. From your perspective at a really high level, where do you think financial technology can be the most helpful here? Or maybe put another way, what do we need to see more of out of the fintech ecosystem to really start to turn this tide?
Yeah, well, I think first we got to be very clear about the two problems that's making it really difficult. The first problem is systematic, and it stems from the current financial system. And the current financial system, alongside the regulatory and compliance controls, are designed to protect the product as is. It's not necessarily designed to change anything about it, or to make it more accessible, or to do anything with it. It's just literally designed for as is consumption. An example of that is, if you think about the recent incident that happened at Navy Federal Credit Union, when they were clearly not offering certain types of loans to marginalized communities. At the end of the day, you could look at that example and say, well, that's wrong, but they would say it's too risky. As a technologist, I would say, well, there are newer underwriting methods that are currently, regulation and compliance would say no to, but that bank doesn't have the innovation or the flexibility to try to figure it out, nor are they incentivized to do so. And you see that across financial services. What I will say, as I thought with open banking and the emergence of the things that Plaid do, and the ability for some startup person like myself to create a new type of neobank with the same type of checking account that we're all offering, that's also not a new product. At the end of the day, there's nothing new about it except for a marketing campaign. So that the entire premise was actually just a disguise, more so than anything. The other problem, so one problem is the systematic issue. The other problem stems from the fact that as it relates to the regulatory environment and the capitalization that's required, right? It's not currently the current market condition is really not conducive to any type of innovation in financial services right now. And however you peel that layer, the current regulatory environment has no pathway to create new products. And I'm under the assumption, because of raw history and raw data, right, that if the current products are not being assessed by the market, if the current products don't work, they don't work. It means you need new products. You need to think about things differently. And you need a regulatory pathway for innovation. Today, there's absolutely none. And then on the flip side of that, if I'm a partner looking to capitalize or give money to a founder trying to go out and tackle this problem, I got to take into account regulatory risk. I got to take into account so much to even think about the at the end of the day, is this founder just really trying to fix something that's systematic in everyday consumer, everyday American life? So there's challenges, and that's what makes it really difficult. It's that systematic engine, and it's the capitalization and the regulatory environment of today. Both of those instances make it nearly impossible to bring real innovation in the fintech.
Yeah, I mean, I think this is a really good answer. And so many of the people that I know in the fintech space have been frustrated by some of the pieces that you're talking about here. I mean, obviously, the capital crunch is very well documented. And I've spoken to other people on this show, including some venture capitalists, about where that's coming from. And there may be some potential good news on the horizon there, although we'll wait and see. But I think the big piece that I find fascinating is this idea that in order to really solve some of these problems, it does require new products. It's not about delivering the same products in a different way, in a different package. You put it on your phone instead of having to come into a branch. And not to disparage companies who are doing that. That's valuable work, and it is certainly more useful to be able to access some things from the comfort of your own home. But at the end of the day, the actual financial products that are available now are fundamentally very similar to the products that were available 20 years ago, 30 years ago, 40 years ago. A mortgage still looks like a mortgage, a credit card still looks like a credit card, a checking account still looks like a checking account. And I think this is one of those areas where a lot of people in fintech and outside of fintech have expressed legitimate frustration that we haven't seen a lot of these kind of new ideas, new products that technology can enable, because there have been major advancements in a lot of areas of technology that can fundamentally change how we look at credit risk, how we look at delivering credit to people in different areas. And so, I want to turn now towards SoLo particularly, and as you were looking at all these problems and looking at the just monumental size of the lift that you were trying to achieve, what were your biggest priorities? How did you kind of settle on what you could target first that was realistic for you to be able to accomplish?
Yeah, for us, when we looked at the market, I will tell you the first thing. We didn't want to do more of the same things, right? There are enough credit builders. There's enough financial literacy. There's enough budgeting. I always tell a story. If you want to know the best budgeter in the world, meet someone who lives off of $20 on a weekly basis. I promise you, their level of expertise and understanding of when a bill is going to actually hit that account is genius at best, or at worst, right? It's a genius at worst. So when we didn't want to do the same thing because it doesn't work. So for us, we tried to identify the real problems that we saw in our communities, and we try to back it up with data. And we kind of identified two real problems. I think that the first problem was this concept of the real American. And what I'm really referring to is 70% of Americans today live with very, very limited savings. That means the savings that they do have, it doesn't allow them to withstand an emergency or the inconsistency in their cash flow or their income. So what that means is, in certain seasons or certain time periods, they're gonna get into a situation where they need short-term capital, and the entire payday or subprime lending category, which is from a debt or credit instrument, is basically a roughly like around a $300 debt product. Um, that's where they thrive, is serving this type of consumer, and that's really I joke this that's really the only financial product that was ever really created for the average American or the everyday American, and it's the same today as it was 50 years ago. But the what I'm ultimately saying is that those particular products are really expensive. And let's put yourself in an average American example, for example, or like a scenario. I'm a single mom. My child is sick, and all of a sudden, I now can't work the planned hours I thought I was supposed to. So therefore, my entire budget for that pay period is off. The way things work out, that's also the week that I get a parking ticket, for example. So not only do I need a short term cash to put food on the table or to pay a particular bill, that if I use a credit card, it's expensive, or I use a payday loan, it's expensive. But if I just don't pay that parking ticket, I know in LA a $50 parking ticket can turn into a $250 problem. That all of these problems, what I would call, take advantage of this scenario, and that's this scenario based on our data happens 4 to 8 times per year on the average American. And that's why it's so hard for them to get out of scenarios like that. That scenario is going to happen regardless. So number one, we said, listen, we have to provide an extremely flexible cash instrument, loan instrument. It needs to be flexible. It needs to be able to not be predicated on credit. It needs to have better underwriting, better risk measuring, and it needs to also not be predicated on a specific type of income like earned wage access. Because based on the scenario I just told you, right, the hours may fluctuate. Or here's the picture of a real American. They may have an hourly job. Let's just say they work at a grocery store, but they also Uber drive, and they also sell things on Etsy. And their grandmother has been sending them $250 every month for the past 20 years. That's technically what the snapshot of their income really looks like. So we needed something really flexible so that it's much more flexible than the planned hours, but you're able to truly assess who they are. On the other side, I am of that same American, but I'm in a better season of my life. It could be tax season, but I have a few $1,000s in my account, and I got things under control. The biggest problem with that group is their money is sitting in deposit accounts that are not growing any yield. My co-founder always tells a story about his father, who worked at General Motors, literally had $50,000 into an account that never really grew, and no banker was calling on his father to manage his funds. So his wealth position did not grow over time. So number one, you have to make it grow. So what we thought as a company is, like, we got to find a way to give flexible cash to manage the inconsistencies. And on the flip side, we needed to figure out how to create an asset class that will enable their deposits to grow, so that in the event that emergency comes back around or that inconsistency comes back around, as we know that it will, they can actually handle it themselves. And that's the power of, when we looked at these two problems, we like every single concept that was like, give them what they already have, we said no to. And we kind of went back to this concept of peer-to-peer, and we looked at the predecessors of peer-to-peer. But one of the biggest things that we noticed that they did not do is they did not take peer-to-peer model and pushed it to the subprime market. And if you look at all of the predecessors, they were focused on like higher dollar value loans, longer term loans. They were prime loans. They were like $1,500, $3,000 loans to go remodel a bathroom. right? That they did not figure out that where the peer-to-peer model concept would work best. Our premise and our thought was, number one, the core insight that these two individuals are the same group. Everyone thinks they're so different. They're really not. They're just in different seasons of their life. So we felt like because they're the same group, we think peer-to-peer will have a unique ability to work, combined with the fact that these would be short-term, small dollar. I think that frequency is going to do two things for us. It's going to allow us to create a short-term, high-frequency risk algorithm that we believe that we're, due to the high frequency, is going to get smarter faster. And on the flip side of that, we felt that the human insight, that short-term nature, is going to make it easier for us to extract yield for the lender. And to be honest, that's what happened. It was a social experiment in the beginning because everyone said it wouldn't work, but it's working, and it's working really, really well.
Yeah, and I just have to applaud you for the creativity there and to really look at the actual problems and kind of get down to the roots of them. Because I think looking at people from the standpoint of, these are the same people who can be on either sides of the coin. And sometimes you might have a little bit of extra money that you need to make grow. Sometimes you might find yourself in a position where you need an extra $50 or $100, not a full bathroom remodel loan. And it's not just about kind of taking people and cramming them into products that you already have. It's about looking what products you kind of wish existed or what products your customers wish existed, that I think is really impressive here. And I think, looking at it from the standpoint of the people who come to Finovate, the people who are active in the space, virtually all of them hold some debt, whether it's a mortgage or auto loan or something. You are holding some sort of debt, and you're also holding some sort of investment vehicle. People don't get cleanly divided into investors and borrowers, right? Most people are doing both. And somehow when we get down to some of these underserved communities, there's this perception that actually, you're all a borrower or you're all an investor. And the flexibility that you're giving people to engage wherever they happen to be at that moment, I think is really impressive. We unfortunately don't have a huge amount of time to continue to discuss this, but I do have to ask one question because I know that Serena Williams venture capital firm is heavily involved in SoLo. And I just have to ask, have you had a chance to meet her? And I also just want to know, what's it like working with someone like her who's so driven and competitive, and how she might have helped push you in ways that have helped make SoLo what it is today?
Well, number one, I'm really thankful for her presence. She is highly involved. She is highly engaged. I'm really thankful also for her ability to give us a chance. She's always asking the question of what else do we need and how can she be helpful. And I think I think that she's like that with all her portfolio, because I wouldn't know why she would treat us differently, but she definitely makes us feel that like she believes in the product and its purpose undeniably. Like there's like a true understanding of the product and the impact it's making. It's not what the headlines say. It's not even what my presentation says. It's like, no, I actually know literally the user who you serve. Like I know that person. They're in my family, and I know what you're doing is going to help them. And for that, I'm going to support this as much as I can. I'm really, really thankful for that. But she's on calls. We've met in person. She's very, very involved. So really, really thankful to have her as an investor.
Yeah, no, absolutely. And the big piece I really wanted to highlight here is really just the benefit of having a supportive venture capitalist who understands the mission, not necessarily from the standpoint of, is this going to give me a return on investment? Obviously, every venture capitalist wants a return on investment, but from the standpoint of, I agree with the problem or with your strategy for solving the problem that you're trying to solve, and I support your mission. I think that's incredibly valuable as well. So there's a lot to take away from this episode. Unfortunately, we do have to leave it here, but it's been really fascinating getting your side and learning more about SoLo funds. Again, I've been chatting with Rodney Williams. Rodney, thanks again for taking the time. It's been great.
Thank you, and such a pleasure. I hope that I didn't talk too much.
Oh, no, not at all. Just the right amount.
Awesome.
The Finovate podcast is produced by Informa Connect in association with Provoke.fm Media. Check out Finovate.com for information on Finovate's upcoming shows and to learn how you can get involved. The discount code Finovate Podcast will save you 20% on tickets to all of our events. And you can email us at info@finovate.com for information on sponsoring, speaking, or demoing. Thanks for listening.